Hey there, and welcome to another episode of Simple Money, where we talk about things around money and mortgage and life and stuff between someone a little bit older like myself and someone younger like my son David. So how you doing today,
Hey,
Dave?
I'm doing good. I'm doing good. How are you? Excited to talk about volatility,
I
as
bet
it's
you are
a
because
little bit.
until about 5 minutes ago you didn't know we were going to talk about
Well, no,
volatility.
but I guess it has a relevance in today's market moving in the last couple of weeks. So it's perfect. It's
I
just
thought
timely.
that's why it's a great topic to talk about volatility, and the fact that it comes out of nowhere and just grabs you by surprise is almost the exact point of our conversation, right? Talking about
We're perfect. And
volatility.
this topic
Um,
was a surprise by me. So
yeah, absolutely.
there we go.
So, okay, so I'm assuming that anyone listening to this knows what volatility kind of means, but it just means anything that's sort of rapid changes and things that are going. When we talk about finance, we're talking about things that are going up and down, but it doesn't always apply just to finance. It applies to almost everything in life, right? So there's been volatility in the political markets. There's been volatility in weather. There's been volatility in just all sorts of stuff. I mean, what things in your life, Dave, where do you feel like there's some odd volatility kind of just happening all around you?
Ooh, interesting. It's a good question. I mean, obviously, my mind goes to uh, like first rates, mortgage rates, just because we're tuned into that every day. And one day you could be like, oh yeah, we're going to lock a new client in, and blah blah blah, and the next day it's well, the market moved quite rapidly, and their refinance no longer makes sense, stuff like that. So it can move quickly, and that's kind of what would pop into my head first. Second would be stock market movements, and you know investing in crypto kind of has large swings that I've been used to. So um, that would be kind of the second part of volatility that would play into my life, at least. What about you?
Yeah, no, I think it makes sense. Um, Volatility. I think most people think of it as sort of upheaval, um, but I think mostly it's unexpected.
Hmm.
And so when something happens in your life, emotionally, relationship wise, financially, work, personal friendships. I mean,
Yeah,
all those things are just unexpected and they happen all the time. I think many people crave consistency and crave regularity in their life, even though maybe they don't say that. But because they become stressed when there's change. So volatility is just a fancier word, really, for change in a day. And I do think that most people are stressed out by change, even though they claim to want to have change. Right?
I agree. Yeah.
But change leads to opportunities. Right? That's how I kind of view it. And oftentimes, if there is change in something, again, because so many people view this as negative, I think to the degree that you can change your mindset to think about it as something positive, or at least an opportunity, because not everything creates an opportunity, but most things do. There's
Yeah.
two sides to kind of the same coin. And wouldn't you kind of agree?
I would 100% agree. Yeah. Um, and well, yeah, I mean, I think, like you mentioned, I think it depends on what is volatile. Obviously, you don't crave a volatile relationship or something something like that. But you might, me, somebody who's young, might be like, okay, I'm okay that Bitcoin fell 10% a day because it's an opportunity, and I have a long time that I'll be investing in Bitcoin, right? So I think yeah, volatility can depend on, I guess, what we're referring to there. But um, yeah,
No, so that's great. So I think you bring up maybe, when we focus more around money and finance, probably the most important thing to understand about volatility is that when you are younger, at your age and there are shifts in the marketplace or shifts in sentiments and so forth, your time horizon, as you say, is much better to recover, right? So someone my age, who just turned 60, if I suddenly lost half my money in crypto, and that would be far more difficult for me, right? And so I think these are important lessons as investors. And even if we talk about the things like housing and real estate, right? So time horizon is really important.
hmm
Um, and so the younger you are, the longer your time horizon is. And so that's a good thing. That doesn't mean you take unnecessary risk, but when there is volatility in the marketplaces, I do think there's going to be greater opportunity, which means greater upside
Yep.
over time. Whereas if I see an opportunity, I go, oh, wow, okay, crypto's down. I think it's bottomed out. I think it's going to go, I'm just going to dump, a bunch of money in there, right? Which in my case doesn't make a lot of sense because we don't know which way it's going to go. And my time frame to recovery, if I'm wrong, is much, much shorter. Whereas if you could do it, your recovery is much, much longer.
Yep.
So that's just one lesson, I think, easy takeaway, from this kind of volatility stuff. So what else? What else would you think about?
Um, well, I mean, one thing that really comes to mind with volatility, I mean, just kind of with the word volatility, sometimes, in my mind comes recession. And I don't, I wasn't really involved at all in the last 2008 recession or 2007 recession, right? I was too young. And so I don't know the full effects of a full blown recession like you
Sure,
might.
sure, you
Oh,
were.
sure, sure.
We couldn't go out to dinner as much. We
Yeah,
couldn't buy stuff, and so you were in an economic downturn and didn't even know it.
I was, but I was a kid, so yeah, it didn't really matter. Um, I guess me paying the bills or whatnot on my own, that dynamic has not really showed its face in my life, right? So that's one that I don't know, right? Because for me, I'm like, oh, okay, it's an opportunity to buy more and buy the dip per se or whatever it is. Um,
And what does that mean? So, I mean, I don't know that everyone listening would
mhm.
know what buy the dip means. I mean, it's a pretty common term, but that doesn't mean people get what that means.
Yeah, yeah, essentially. So like today, the stock market's down a couple percent or whatever it is. And so technically stocks are cheaper today than they were yesterday or the day before or whatever. And in theory, stocks will recover and move higher in general. And so, buying stocks today at a cheaper price means you'll have a little more return and a better investment. So even though stocks are going down, it just presents an opportunity to buy. So essentially, stocks are on sale per se, if you want to look at it that way.
Yeah.
Uh, but I did see a really interesting tweet this morning, or I don't know, today at some point, that the last 8 months of stock market gains have all been erased in the last 12 trading days. So there you go.
So wait, say that again, and that's
Yeah. So
important.
the last 8 months of stock market gains, in this case, I think it's referring to the S&P 500. So that's 8 months of gains has been erased in the last 12 or 11 trading days. And so now the stock market today is the same place it was 8 months ago, essentially. And I think that brings up another point that usually when we're talking about the stock market moving in volatility, it's a lot more a quicker run to the downside. So stocks move a little quicker when they're going down, and that plays into fear and stuff like that. And
And
mindset.
what do people tend to do when they see, a quick sell-off like we've seen? Although 8 days is not really really quick, but it's or no, sorry, 12 days.
Yeah, whatever it is. They tend to sell. Get out, get out.
And why do they sell?
It's psychology. It's fear, right? It's
Yeah.
kind of like, oh, you're you're going to be losing money, blah blah blah, whatever it is, and they say the best time to buy is during.
And you want to hold on to the money you already had. So if you're back, if you had $1,000 8 months ago, and then it grew to $1,500, and now suddenly it's back to $1,000, you're like, okay, at least I still got my $1,000, right?
Exactly.
Which is the whole psychology around what are called Japanese candlesticks and trading and all the
Mhm.
things we're not going to get into.
Yeah.
Um, but yeah, that's what happens when people, they're like, I don't want to lose my original investment, so they sell, which then does what?
Well, then it can continue to go down a little bit or go up. Who knows? But
Although it tends to, if everyone's doing the same
oh,
thing,
if everybody's selling, yes, it's
or
going
if
to
everybody's selling, what's going to happen? The
yeah,
price is
it's going to run lower.
just
Yeah.
going to keep going because everyone's trying to undercut everyone else, and
Exactly.
so it doesn't take well. It takes conviction and it takes discipline to not exit when the market is down.
Hmm.
And again, going back to our volatility conversation, being younger or older, younger, I mean, it is a time to buy, right? That's when you go back in, assuming you have, stable income and you have enough assets to
Yeah.
get through difficult times. And you're not putting money that you need for daily living into it. But if there's an allocation of your money that's invested, you should consider going back in, right, and maybe
Yeah,
buying more, right?
exactly. And we've probably chatted about it on this podcast before, but kind of the concepts of dollar cost averaging or investing, weekly or whatever it is, right? You kind of have a set schedule to invest, and you buy no matter what the price is. That way, you're getting in at different points, whether it's low or high or whatever it is. You're kind of always investing, so you're always building up that account, and it doesn't matter if there's these interday changes or whatever it is. You're just staying the course.
That's great. And just to just bounce back to dollar cost averaging, because yeah, we have talked about it, but it's a common theme and people forget. So dollar cost averaging simply means that if you're buying the same investment, whether it's crypto, gold, oil, some stock, it doesn't really matter. You're buying it at all. If it's on a regular schedule, it doesn't matter when you're buying it. So the average cost of it over time will average, right? Sometimes it'll higher, sometimes it'll lower. It doesn't matter because generally speaking, it's going to slowly go up. And then the average cost of that investment ideally is going to be a little lower than where you end up with it. So it's an important concept. And you can't worry about the daily trading because you're dollar cost averaging and so forth. So, what are our couple of key takeaways? What would you say some takeaways are for younger investors, Dave?
Younger investors, try to leave emotion out of it.
Mm-hmm.
Emotion plays a lot into fear selling, or on the other side with I'll mention meme coins because they've been in the news recently and are very volatile.
Okay, good. Yeah, yeah, that's
FOMO
good.
buying, buying because you think it's going to pump, and then it ends up you get in it, you lose quite a bit
Get
of
on the dump.
money. You get on the dumps. So try to avoid emotional side of investing and whatnot. Dollar cost averaging or having a set schedule of when to invest, and then spreading it out over multiple different investments. Diversification. I know we've chatted on that as
Diversification.
well, but if I mentioned Bitcoin, Bitcoin is going to be a lot more volatile than buying the S&P 500. So spreading risk around does matter, and if you're younger and have a longer term horizon, buying dips good, letting stocks go on sales good, and continue to buy, and as long as you got that emergency fund that you don't need to dip into, all the other investments, then you'll be good.
Right. I think that's perfect, Dave. Also, I would say that if you're a seasoned investor, and maybe that's the wrong word. I don't mean seasoned as like you've been investing for long. I mean you're like older, like me. So you're a little more seasoned in life. In which case, your investments over then is a little different, right? So volatility can be a little riskier as you're a little bit older, but at the end of the day, there may be some opportunities, but you want only a small portion of your portfolio into sort of riskier assets and things that may be more affected by portfolio. You tend to move into a little bit more conservative level of buckets, and you might consider a bucket idea that you have. The money that you plan to retire with is in a bucket that's growing but relatively safe. Maybe you have a short-term bucket that's your money you need to live on from month to month to month. And then I think it's perfectly appropriate to have a play bucket. And maybe that's not the right terminology, right? Because money is serious and it shouldn't be played with. But I think it's okay to have a bucket where you're allocating maybe 3 to 5% of your total assets into some, more volatile type of things, right? And so consider that. But at the end of the day, make sure that your financial house is in order. You can have your financial plan. We always suggest working with financial professionals and so forth. But any final words around volatility?
I'll leave with something that Keith Fitzgerald says a lot in his stuff. He's an investment kind of guy.
Okay.
When in doubt, zoom out, referring to the market, that it's going to, when you zoom out over time, you see the market always goes up.
Great advice. It's always back to the basics, right? No matter what's happening in the world, it always comes back to those basics, that high level overview of why you're doing it, how you're doing it, and stick to the plan. Don't get messed up in the daily stuff. So,
Exactly.
awesome. All right.
Cool. All right. See you.
Have a great one.